Welcome to the Dividend Talk podcast, episode 63, our September Watchlist. Hey guys, welcome back to another episode of Dividend Talk. Today we're going to discuss our top 3 watch list for September. We'll pick 3 each. We'll also have a look at portfolios from the members of our community, and we'll answer some questions from our community also. So stay tuned for that. See you on the inside. Hey, European DGI. Happy Friday. How have you been?
That's how I see it. A really easy question to ask, but difficult to answer because I've been exhausted from work. Summer has finished officially. Everyone got back to work and everything came at the same time. So I don't know how it is for our listeners. I'm curious as well. But this was a busy week, but it also feels good to be a bit back into the rhythm, I must say. And I feel a little bit at work more enthusiasm. I see people meeting again a little bit, also on site. So that's so nice after 1.5 years, right? It's really, really nice. So it gives me so much energy. I'm so happy with this.
Yeah, we got an official date for Freedom Day. Ireland is back open on the 22nd of October. We can, pubs, restaurants, nightclubs, everything, vaccinated, unvaccinated, we can all get back to normal. So it's been a long time coming. And I'm just so glad. Like I cannot wait for Freedom Day. But until then, I have holidays in Spain in a couple of weeks, so looking forward to that as well.
Right. You can use your Freedom Fund on Freedom Day.
Yeah, I can. I might buy Alibaba on the dip and make a fortune off
it. Good.
So what's been going on in the news this week? I haven't been following too much, so I hope you have something for me.
Well, yes, actually, because we're both Shell shareholders, right?
Yeah.
And what caught my attention was that Shell wants to install 50,000 charging points for electrical vehicles by 2025 in the UK. And I think globally they want to install 500,000 in the next 4 or 5 years.
Wow.
And this will be for me so interesting because the UK government is, I think, talking about by 2030 to not allow sales anymore of combustible engines here. Yeah. So this will be so interesting because now we will really start to learn how this company can shift away when it comes to transport sales, let's say oil, because they do much more than that, of course, with LNG, because it's actually more selling LNG. But to see if there's profitability in it, because if you think about Shell, how it earns money, it's effectively all kinds of monopolies because they have a deal with a government and there's scarcity here. But when it comes to charging points, I expect the margins to be much, much lower. Not the same as oil. Investments are different. You don't need to build assets for 8-9 years to be able to do this and before you get revenue. So the entry barriers are much lower. So I'm wondering really how Shell will behave in such a world and if it can transform into that, right? And they have massive cash flow now. The balance sheet is really sound. So making these investments out of the current cash flow is wise, but they'll have to figure out now where their profit margins will come from, right, in the future.
So I always wonder, how do they actually make money from these charging stations? Are they charging a higher unit of electricity? Are they renting the equipment? Where's the money coming from? I don't quite understand that bit.
No, me neither, but I'm not an EV owner. But if you read there in between the lines, it says like Shell effectively in the UK has something like if the government doesn't fund it, then Shell pays it, but then on their commercial terms. And I think that's where it comes down to. What are their commercial terms? Yeah. So we'll see. And, we know that most of the electricity doesn't come from sustainable energy. It comes from gas, liquid natural gas and such. And, Shell is a big supplier to that as well. So it might be in the end that they start owning half of the supply chain there, maybe they buy a utility company, right? A grid operator as well
Yeah.
at a certain moment, and then they just own the supply chain. From cradle to grave, actually.
It's not. It's not a bad plan from them at all, and I'm sure they have plenty of stations throughout Europe and worldwide where they
Yeah.
have petrol stations where they can easily put in a couple of charging points.
Yeah.
So I can't see being too big of a challenge for them to reach that target.
So you know how I look at Shell a little bit as a pharma company, that we know that their major drug, like ABBVie or something like that, will go. Its patent will expire, let's say, in 10 years from now.
Yeah.
So to be clear, if you look at the energy mix, transport makes a big impact. Yeah, but it's still not like the majority of their revenue, right? Think about all the downstream operations, just the clothes we are wearing, all this stuff. Like the whole economy runs on oil. It's not just cars that people think about. It's impactful, but there's still so much why we have oil dependency. But I find it really, really interesting now to see, like, okay, let's assume that they go off patent in 10 years from now. So what it becomes now is like, can they do major acquisitions with good profitability? Can they provide as a company that they don't influence too much those companies, let them grow? So I wouldn't be surprised if you see in Shell a company like IBM, yeah, that transformed over the years, or like Nokia did. I wouldn't be surprised if we see something, and maybe Shell doesn't make it. I don't know, but Total, Shell, I think those will be the future energy companies. It will be focused probably around energy, but it will be really interesting to see 10 years from now how they look like as a holding, as an example.
Yeah. And I mean, BP, I think, should be one that should be mentioned there as well. And I believe they've a little bit of a head start on Shell here. They've acquired a company. There's a Charge Point or Charge Masters or something along those lines last year. So it'll be interesting to see how this all plays out. And Couche Tower is another one that I was looking at for this reason, because I know they're doing charge points in Scandinavia and introducing that into Europe. So maybe I won't have to move to them if my beloved Shell are doing it.
Yeah, and what is nice about Shell now, it has the cash flow around these oil prices to just buy companies for their cash flow. Even if they overpay a little bit, it's more like future cash flow protection. So they could probably buy, grid operators are difficult, right? From that point of view, but why wouldn't they be able to buy Enagas or Red Electrica or something like that in Spain? I know that they are maybe also politically influenced, but it's not like oil companies are not politically influenced. It's like the joint ventures with countries are their main business model, right?
Yeah.
So it will be really interesting to see, and I think we really see now that Shell starts to move in this, because in the past they did something with solar energy, but I think that was not serious. I think now it is really like serious business. Like, how do we shift our company into this kind of zero neutral climate stuff and such?
I mean, our hand has been forced, aren't they? Europe is having
they have to.
I mean, a no tolerance level, and the UK, Ireland is similar. There'll be no petrol or diesel cars. So the hand is forced. They might as well do it now before it's too late. So props to them. And you know, when I see news like this, it makes me happy that I held on to them. I always feel like I've made the right decision.
Yeah, exactly. Well, I think if they would need to live off charging points, then the dividend will be cut.
We're in trouble.
It's simple like that. Yeah. So, but they need to figure this out, where the money is that replaces the cash flow. So yeah. So that was my news. I find it really interesting. I keep a close eye on these kinds of stuff, because this is what the future is for Shell.
Cool. So today we're going to talk a little bit about our watch list. I know both of us write posts, and I do this sporadically, you do this sporadically, and they're quite popular. So we thought it might be a nice topic to give 3 companies each that we're currently going to watch for September. So I might let you go first. Who's number 1 on your watch list for this month?
Yeah. So for this month, it's Okay, so I don't have a number one. I don't do my watch list like this. Yeah, I have my watch list more like 3, 4 companies typically that I just observe during a month. I really try to buy from them. You hardly see me ever buying suddenly other companies, although it might happen sometimes. But so maybe that's also good to clarify why I have a watch list. Often, when you think about what happens in the stock market, that suddenly stocks drop or something like that. These watch lists are already typically about stocks that hover around my price target, usually within a range of 10%. So I want to be prepared, have done my homework, so that when I see price action, and I can just buy without any need for homework. I just need to check like, oh, why did suddenly dip? Okay, does this impact long term? No, take it. Yeah. So that's why I do my homework, and this is why I have watch lists. And sometimes I buy nothing from the watch list and I just accumulate on something that I might have already just because nothing happened in this watch list. So that's how you need to see it.
Yeah.
But Kroger is my first company, and Kroger is something I published a video the other day on my YouTube channel last Sunday where I analyzed the 13 Fs of most popular investors. And Warren Buffett has been from the companies that stocks that he was adding the most in volume. It was Kroger. And when I started to read up on Kroger, I thought like, oh fucking hell, this is just Ahold Delhaize in the US. Yeah, so that's what, and that's why I started really being attracted by Kroger. The dividend is not so high from that point of view. It's around 1.86% at the moment, Kroger. But there's so much to like about it, and I knew so little about this company. So I also put it a bit on the watch list to bring it to people's attention, just in general. It's I think the largest supermarket chain behind Walmart in the US. It's in 32 or 33 states. It has a revenue of 132 billion on a yearly annual basis, which is, I believe, quite a lot. They have been improving gross margins over the last years from 20.6 to 20.8%, which is a good sign that the revenue. So what that means is that because if you think about accounting, you always talk in fixed cost and variable costs. So it means that the additional revenue doesn't increase so much the fixed cost as such, and it's really more about variable costs. And it also means that some of the fixed costs therefore allow them to increase the margins. Yeah, so this means just scalability effectively. So they have the scalability, which is also really nice to see. And I said their dividend growth has also been really nice because they grew the dividends, I believe, on the last 5 years at, I think, 11% annual. So it's a good dividend grower at 1.86%. So it's meeting the Chowder rule as well. A payout ratio of 44% based on EPS and 27% based on their forward guidance. So if they would pay out like 50%, then the dividend would be around 3.5%. So there's so much dividend growth ahead of them still. If they keep doing this with 10, 11%, I just find it attractive. Usually I don't buy below 2.75. But taking the Chowder rule into consideration, if it hits 2%, I might actually dip my toes into this. It's not something that I even have in my allocation strategy, but I just discovered it recently, and I find it an interesting company. I like such companies.
Yes, do you know what? It's a company that it's always escaped my radar as well. Out of interest, when did Buffett say he is starting to buy these more and more?
Well, Buffett didn't say it, but you see it in the 13F. So it's based on the Q2, and the price has moved up since then. So
that's why I'm asking. I'm just looking at the price since the 9th of July, and it just went like a rocket ship.
I'm realizing that. Yeah, and still at these prices, I find it attractively priced. So Buffett just made a really good purchase in Q2. Credits to him. But still, for me, I mean, it is a forward earnings of 15. Yeah, for a consumer staple, you can expect this, but you expect this under different monetary policies. So most companies trade around 18 or 20 at the moment. So I would say it is probably going towards fair value at the moment. So for me, if I do something, it's initiation position, a small one, so that's in my portfolio, and then when it dips or something like that, it automatically pops up for me. So that's how I treat Kroger as a first company, which is on my watch list. So if it touches the 2%, I might buy a little bit of it.
Okay. No, good. No choice.
How about
So
you?
yeah, so I use my watch list in similar fashion to you. I always have my whole portfolio in the background, so I don't always just exclusively buy from my watch list. So I usually have my portfolio, but I always try and include maybe one or two companies from the community, from people that I chat to on a daily basis, companies that I don't necessarily know, but they're there, and it's a chance for me to get to know them a little bit better. So there is a couple of companies here that I don't think I've mentioned on this before. First company on my watch list this month is ABBV. I mean, I've wrote about ABBV before. I think they're a really good company. We know that they have a high, what to say, tolerance or high dependency on their Humira drug, but I really love their acquisition of Allergen, and we're starting to see that come into play. They have a long history of dividend growth. I know most of that is based on their before the spin-off from their parent company. But I mean, they have a decent yield here of about 4.5%. What has interested me this month is that we've had I think it was 11 or 12% dip in them this week, based off the news that there is a label going to be added to some of their products, stating that it can cause heart-related events, cancer, blood clots. So this is around a small part of their company called Rinvoq, which I think equates only to about 3% of their overall revenue. So it's not huge. It's not a huge amount of revenue. But I think the market reacted the way it was is because Humira focuses on these drugs as well. So there's obviously fear there at the moment, which accounted for this risk. At the current price of 112, I mean, I'm close to automatically buying. Once these drop anywhere near $100, I'm always automatically buying them. So we'll see where they are when it gets the payday for me. But they're certainly one that I'm going to consider buying this month.
Yeah, I mean, I've got a full position in ABBVie, right? It's for me, I believe, a tier 3 company. But what do you think about their debt profile?
I mean, they do carry a lot of debt, and most of that has come recently because of their acquisition in Allergen. But I think they needed to do that. This was a huge acquisition, and I think we're only starting to see how much that is starting to bring to the table. They've got a huge pipeline of products coming up as well. We spoke there of Rinvoq, which is 3% of their portfolio. They have lots and lots of little products like this coming up that is starting to build up their portfolio, which once this patent runs out, which we all know it is going to run out soon, they're going to need something behind it. So look, I think that it is all priced in. They are a low price for a reason. We all know that's it, but I'm not too concerned with their debt profile.
And I'm really glad that you're saying that, EMF, because if I look at the community, people tend to ignore it, but their debt looks really bad. Yeah, they have a debt to equity of almost 600%, an interest coverage of 3.4. Yeah, so that's really low. If you look at other poor performing companies around us, like AT&T, this is really just bad from ABBVie. Debt to capital, 86%. Solvency ratio below 20%. These are all red flags, and their credit rating is one of the lowest here. It's not really that much be above junk status from a credit rating agency. So while I really like the company, there's just one thing that I urge every investor to look at here. They need to pay down debt massively with the cash flow now that they have, also after the Allergen acquisition. If there are any hiccups in the debt pay down in the upcoming quarters, you really should be concerned. There's a reason why, like you said, ABBVie trades at the discount, because if you look at EPS, it all looks good, but really don't ignore the debt profile. Just know what you own. That's my only advice that I give here. I feel comfortable as a tier 3. I really wouldn't feel comfortable as a tier 1 company for a company of such a balance sheet. If something happens, and we know this is a drugs, right? If something happens like that, suddenly the drug is at risk, they lose their cash flow to pay down the debt, and then they're in trouble. So that's the risk here for me for ABBVie. I love their management. I love the Allergen acquisition. Yeah, that's the only warning I have for investors, because I want sorry, but I want to give this voice because many people don't speak about this. Many people don't analyze it, and this is really why ABBVie is trading at a discount. It's the debt.
Yeah, but as we said, in this, we're going to start seeing inflation happening. We're going to start really seeing how that impacts some of these companies. They are paying down their debt. We've seen that in the last couple of quarters.
Yes.
They are fully aware of the debt that they
Yeah.
hold, and they will do that. If that means the dividend will be in trouble in a couple of years, it might be, and we
Yeah.
have to be honest. They might sacrifice the dividend, but at the moment, I'm not. I'm not overly concerned.
No.
We will have to keep an eye over. I suppose most companies we look at. Well, I look at maybe on a yearly basis. With companies such as ABBV or AT&T, where you have a high amount of debt, you probably have to pay attention to the numbers on a quarterly basis. Just to get those warning signs in advance.
That is with ABBVie here. You need to check every quarter if the debt is being paid down as what you want to expect. And really, they have excellent management. They have been doing it. It's all going per plan. But for instance, interest coverage of 3.4, if now suddenly the interest rate starts to increase, it becomes much more pressure on this, and that means less cash flow, less left to pay down debt. So these are the things just that we need to pay attention to. I think personally, from what I've seen, I've got confidence in the company that they will get the debt to a proper level, but it will take 5-6 years still. It's not a short path, and it might be just on time before the off-patent and such start to impact them. So it really comes down to management execution with ABBVie.
Yeah, and hey, that's why there's no rush in buying these guys when they jump up to $120, $130, because I always think because of that risk, they will always come down around the $100 range.
Exactly. Yeah. So, but it's I think if people don't own it, it really deserves some people's watch list. So it's really a nice pick, EMF.
Cool. Let's get a second pick then from yourself.
Yeah, let's go to good old Unilever. So there was some news around Unilever because I believe JP Morgan downgraded it. I think they're just not happy with the share price performance, management execution. And yes, generally I'm with that narrative. I don't think that they have excellent management execution here. I think they're really struggling with their stakeholder approach versus shareholder approach. We see the same at Danone. Yeah, it conflicts a little bit with uber capitalistic expectations from shareholders. But generally, I've got my fair value around 45 euros. So if it dips to 45 euro, I've got an automatic buy order outstanding. I also aim to sell a put. I missed a little bit because of being busy at work, the opportunity on the dip that we had yesterday after this sell-off. It went already back to almost where it was trading before. I saw a lot of fear on the fora in the Netherlands around Unilever. That reminded me that's quite unique as dividend investors, that you see this as opportunities to buy. With the others, they felt like it was evidence of that the company, I don't know, is going bankrupt or something like that, which makes me laughing from that point of view. But no, Unilever, I mean, we know 55 years of dividend history without dividend cut. The 5-year dividend compounded annual growth rate of 7% currently yields 3.6%. And Unilever would usually not be on my watch list because I own quite a lot of it, but it's more because there's hardly any other alternative that I see around. I own half a position. So if it dips to 45, I would just buy, for instance, again, I'll up my position, I don't know, from 50 to 60% or something like that. So that's why it's on my watch list here. I feel really comfortable with owning Unilever. I see that their multi-year lag in price appreciation allows me nicely to accumulate into the company. And people say about the margins, what I just see is once they get a proper manager, there's so much value to be unlocked, and then you can see this typical pop-up in share prices, but I don't want that at the moment. I'm still in the accumulation phase, so for me it's actually quite nice.
I'm starting to see a trend. You're sticking with consumer staples this month.
Yeah, because I think consumer staples is one of those sectors that is just attractively valued at the moment. It's not having this hype of tech stocks and everything. And it is hard to find these needles in the haystack at the moment. I just don't feel comfortable paying more than 20 PE generally, unless it's really a Microsoft that actually also grows with more than 20% per year. But I don't need to own, I don't know, companies that trading at 25% at hardly no growth, at 25p at hardly no growth. So yeah, that's why consumer staples is a natural for me. Even the real estate sector, um, those stocks that I'm interested in, like Realty Income, I just find them on the expensive end at the moment. Yeah,
And that's my biggest problem at the moment. We do portfolio reviews every quarter, and if you remember last quarter, my allocation in consumer staples was nearly 50% of
yeah,
my portfolio, and I've deliberately this month said, because last month I bought some more Ahold, and I've been adding to Unilever as well. This month I specifically said, okay, I have to stop buying consumer staples,
yeah,
otherwise it's going to take over my whole portfolio. But I'm struggling.
yeah.
I'm struggling to find value in other areas, and
Mm,
that's one of my problems at the
yeah.
moment. Maybe I'm not looking hard enough, or my scope is too small, but
Yeah, but
that's
you bring up a good point. Look, my portfolio is a little bit more diversified after last year. The pandemic happened. I used this May opportunity. I'm still having consumer staples as my biggest size, but it's not yet at that size as what you're talking about. And actually, during those times, like now, I don't mind even to be overweight in a certain sector. I really don't mind. Um, but this seems to be a little bit like a never-ending story. Yeah, and that's why here it might become too early too big. So you make a really really good point here. Really good point.
cool. So moving away from consumer staples from myself, my next one is actually in the financial world, which is called Blackstone. Now, this is a company I don't think I've heard a whole lot about in our community, and I wouldn't really class it as a typical dividend growth stock. So they do pay dividends, and they do pay 85% of their distributable earnings, which I think is key here for these. So they're an asset management company. We know we had Dividend Athlete on here a couple of weeks ago, who gave us an asset management company in Europe. These guys are based over in the States. They're involved in real estate. They're involved in SPACs. They're involved in credit rating. They're getting involved in insurance as well. So they have a huge range of products that they're invested in. And what kind of struck to me was their returns over the last 3 decades. So you're looking at a minimum of 12% returns was the lowest, which is quite incredible over 30 years. It's not really a company, an area that I'm too comfortable in analyzing. It was actually a guy called Charles. I don't know if you've read his blog, but he runs a blog called Financial Freedom is a Journey. He's from Canada. I interact with him quite regularly actually, and he's retired. He's living the dream that I want, but he has a wealth of knowledge in these kind of companies. So he wrote a piece on it that I'll link to this. But I think they're a very good company from a growth point of view, not just a dividend growth point of view. So as I said, it's I wouldn't go buying them based on my recommendation, but they're certainly a company that I will be analyzing this month a little bit deeper, just to get to know them a bit.
Well, I really like this pick. It's a bit out of the ordinary. Nice one, EMF. Really nice.
Quite similar to BAM, I think Brookfield Asset Management. I think they're one of their main competitors. So
Mhm.
it's you said you hear the kind of the same companies over and over in our land. So I
Yeah.
try and diversify myself whenever I can.
Yeah, and it's nice that you say that because my title is even European Dividend Growth Investor, right? But I own BHP Billiton, the mining, yeah, and they also don't have regular dividend growth
Yeah.
actually because they have this payout ratio. But with these companies, what is nice is kind of a floor in it. You just know that in general you get 3% dividend yield, but it fluctuates. Then sometimes one year it's 5%, the other time 3%, 4%. So these are typically nice cash machines, right? To help a little bit fuel the snowball in your portfolio.
Yeah, and it really helps that they have a defined, you know, dividend policy. So they have it in black and white. You just read their investor relations that they will pay approximately 85%. And if you go through the history, that's what they've done. They have paid approximately that. So
Nice.
in my mind, if I feel like they have growth potential, which they clearly do, well, then this is going to grow organically over time. So
Yeah. But it's again like you need to know what you own, right? Because in a crisis, it might mean if there's, for instance, less investments at that moment in time, that you get a small dividend cut. But if you have one or two of these stocks out of 40 stocks in a portfolio, then it's actually really just in the margin, right? If that would happen.
And these are not investments for 1 or 2 years. These are, I mean,
Yeah.
their investments take 10 years to play out. So you have to be investing in these for a minimum of 10 years, I think.
Yeah. Oh, nice one. Really nice. And it's a stock you don't really hear a lot indeed.
Yeah.
Okay, so in my mind one, let's take into the financial sector then. It's still Allianz. So Allianz, I bought something recently when it dropped to 200 after this issue they had with the alpha funds there and the fraud case that they have. But then after listening to their really extensively to their earnings call, I got a lot of confidence from the CFO and the CEO. Effectively, what they said, they feel ashamed. They closed down already a lot of the funds much earlier. The legal case is something they tried to settle. They've reserved money for it. But what was nice is that they feel so comfortable themselves with the cash flow that they also, I think, went for 800 million share buyback program. They apologized. Actually, you don't hear that so much for this mess. How often do you hear CFO saying this, right? So for me, I said it was really encouraging, this earnings call, and I know that I need to distrust what they say in general, but something my gut feel tells me like, okay, they have this in control. We'll get there. It's trading at less than 10 PE. So it is a dividend yield around 4.8, which is much bigger than, for instance, Munich Rucksversicherung here. So I find it one of the best values in the industry. I would say Nationale Nederlanden is probably also there, but I like Allianz. I wanna buy more of it. So all the time below 200, I find it attractive, and that's around these prices. What I would like to say is that, and that is something that I pay attention to Allianz for the listeners. What Allianz has been doing with their life insurances, they talk so much about how happy they are and how good they manage it because they have so little, what is underwritings? What's the term? That they pay out less than that they collect.
Yep.
And that this margin has been growing. And I was wondering when I heard that, like, is this something I should be happy about? Yeah, because if they pay out, they keep on paying less and less out to the people. Don't people at a certain moment start to wonder these policies are totally not attractive because they pay not so much out, but I'm investing in it. So I rather see them growing their portfolio here of life insurances rather than focusing on the operating margin, let's say. So it's only a little thing that I will start to pay closer attention to because it might be nice on the short term, but on the long term it can hit them, right? That these become unattractive policies. But anyway, if they would like to get rid of those policies, then they can sell them to Chesnara, and Chesnara takes the cigar butts out of it. And I own that one as well, and it pays an 8 to 9% dividend. So anyway, I will be good.
Nice. No, that's Allianz is a solid pick. We all know you're a fan of insurance at the moment, so I'm not surprised to see one in there.
Good. So what's your last one? Show us the money.
Yeah, my last one again is a little bit different from me. It's a company that I have seen doing the rounds quite a bit, particularly from our US colleagues. It's not so much talked about in the European world, which is Lockheed Martin. So ticker LMT. Actually, we should start maybe putting the tickers on all our stocks. So I'll put them in the description for people that find it hard to hear it. But Lockheed are a defensive company. They're huge in America because they are involved with the US government, with the military. They make all sorts of aircrafts and ships and guns and all these things. And for me, that's quite key because they have a competitive advantage there, really, don't they? I mean, they have such a hold in that space. We all know that in the military, we spoke about this, that you have to have a certain amount of secrecy, or you have to have a certain amount that you can't give away. So you can't see the government changing too easily in companies like this. So for me, they have the perfect mode. They have a perfect competitive advantage. Their price has dropped really, 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 really far over the last couple of months. I don't know why.
Can it be
So
with Afghanistan and Kabul?
I believe it was before that. So they've been,
Okay.
I've been hearing people talk about these over the last maybe 5 or 6 months, that they've buy the dip. I just checked the price there, and it's way below what they usually are. So I'd be quite happy to invest in a company like this. Not before I do my own due diligence, mind you. So I do have to dig into their financials a little bit, but from a competitive advantage kind of point of view, I'd be quite happy to own a company like this. I suppose the only risk that you do have is that because they're so dependent on the US government, administration changes or policy changes can impact them. I just don't quite see it. So I just did a brief overview of them. I mean, dividend yield is 2.8%. That's normally good enough for me. Dividend growth is 19 years, which is perfect. The last increase was nearly 10%, but their earnings has been astronomical. I think in 2011 it was around $7, and at the moment it's up around $26. So it's nearly 3.2 times. Like, so their earning potential has been absolutely superb. So it's a company, again, I don't know a whole lot about, but I do these watch lists. I always have one or two companies that I know that I will pick, and then I have two then that I will keep an eye on. And this is one that I will dig a little bit more into.
Yeah. I mean, I think these companies have shown how strong they are in their performance. I guess I'm such a person that doesn't feel comfortable with having these kinds of stocks in the portfolio. So usually that's why I don't look at them, ignore them. But like you said, they've created so much shareholder wealth over the last decade. It's unbelievable what they've done there. So it's a nice pick from that point of view.
Yeah, I have disclaimer. I have no problem owning these type of companies. If I don't own them, somebody else will. So I don't always agree with what's going on, but I suppose I'm in this game to make money, not to not to agree with them.
It comes down to the sin stock investment, and for me, it's always so really personal here. So I don't mind if I own them via index funds. Really not. I wouldn't sell an index fund for it, but I stay a bit away of them as stock picking. But I actually have also nothing against you or others buying it. I wouldn't care less. Nice one.
Good.
Okay, so maybe this is a time that we close out our main topic. I really liked talking about these stocks a little bit and having a bit of time about it as well to clarify some things. So thank you, and I wish you lots of fortune in the upcoming month. And I'm actually curious if you will buy one of those. So please keep us updated. I would say either via the social media or maybe next podcast or something like that.
Yeah, we will do our portfolio review at the end of this quarter. So
that's true.
We'll find out then.
Yeah.
Okay, so we'll move on to a section that's actually become quite popular, which is our portfolio review. And we have one from Enzo Gonzalez, who's been a long-time listener, I must say. Always message him on Twitter quite a bit. And he has given us, so I'll just call out the tickers and the percentage of the portfolio. So he's got Walgreens, ticker WBA, which is about 7% of his portfolio. Realty Income, which is ticker O, which is also nearly 7. He's got Unilever, so ticker ULVR, which is about 6%. A company called Interpublic Group of Companies, which is ticker IPG, which is 5.71%. And then the last one he has is Gilead Sciences, ticker GILD, which is about 5% of his portfolio. So What was your initial thoughts when you seen that portfolio?
Well, I actually think he has a really nice diversified portfolio, because if his top 5 is 30%, it means that the other 70% is really nice diversified, right? Because it's not a high number, 30% for a top 5. Probably we will be around 40% or something like that. So that's already my compliments there. To see Walgreens Boots Alliance tells me he is also from a value investing point of view here. But then on the other side, I see almost 7% in realty income. So, well, I don't consider realty income a value investment, neither in the last 2 years. Maybe if he took the opportunity last year during the pandemic, then I can tell you only that Enzo has a really good nose for seeing value at the moment when you need to see it. So I actually really like it. I believe he's really investing now since 2020, so just for a year. And to be at this level already, I can only give my compliments, because from all I know from him, he's a self-made person, taking his information elsewhere. Really kudos. I just have my doubts about Gilead Sciences on his 5th position. I've looked into that company multiple times. It has I think it's hepatitis and HIV drug, really popular. And the main difference they have compared to ABBVie, that they struggle to buy, how you say it, to do a big acquisition. They're struggling to replace their cash flow, and the time is really ticking for Gilead. I know they have been growing the dividends for 10% per year, but there's a reason why the stock price is that money, which is of course nice when you're accumulating. But this is really a bet on the CEO. So the CEO is Daniel O'Day, former I said CEO of Pharma and Roche, if I remember correctly. I like that CEO. He has done many small acquisitions because they want to really focus on curing cancer in the end. But this company they need a big acquisition. Otherwise, Gilead will be in problems. So the only risk I see in the top 5 is Gilead. But other than that, I think it's a really nice composed portfolio already. If this is just 1 year investing, I think he can be really proud on himself what he achieved already.
Yeah, and just to give you a little bit of background, he is a self-made man. So he's reached financial freedom for himself and his family, not through investing, through businesses and other ventures. And because of his success in his business, he decided that he was going to invest some of that to try and harvest that into something bigger. So the term that he used with me, and I love this, is that he has financial independence now, but he can fly at an economic fare. He wants financial independence to fly at first class all the time. So he's just trying to grow his wealth. And
Yeah.
I mean, he's a great guy. He's a nice blog. If you go onto his website, it's not about investing. It's about a whole host of other stuff. He's a software developer, and there's tips and all this kind of stuff. But he got in at a really good time. Let's be honest. He got in in 2020 when things dipped. Call it luck, call it whatever. But he picked well. He must have been reading my blog, because my initial reaction when I seen the top 5 was, wow, that's awfully close to mine at that time. Take out IPG and replace that with Omnicom, and take out Gilead Sciences and replace them with either Johnson & Johnson or ABBV. So it's a really diversified portfolio. As we said, it's nice allocation. 6-7% is what you would like. It's better diversified than mine at the moment, where I'm all over the place. But I mean, it depends on how much money you've put into this. But I think it's really good. My only comment would be that you are now looking to grow your wealth. So maybe companies like Gilead Sciences may not be your top 5. So you may look for companies that grow a little bit better than that. But I mean, I'd be happy with Walgreens, Realty Income, and Unilever as my top 3.
Yeah, definitely. Yeah. Now, nothing to add. I think he should be proud on himself after 1 year. I can tell you, I didn't have such a well structured portfolio after 1 year. Far from it. I had Tupperware in there.
Yeah, and I can only imagine the growth that he's seen investing in 2020 to now. So I think it's, I mean, fair play. No, that's incredible.
Good job.
I think it's incredible.
Yeah. Cool. So Enzo, good job. Keep on doing like this, and you will buy first class tickets quicker than you think. Okay, so we also still have a few listeners' questions. We're taking this week some from our backlog, from questions that we weren't able to address earlier. So let's just get started with that. So Jose Carlos is asking, which are your expectations on ABBVie being able to compensate the 30 to 40% EPS drop from Humira? Do you consider that this is already priced into the stock?
Yeah, and I kind of mentioned that above. I do believe that they will be able to compensate this. Allergen is a really good acquisition. We do know, like Humira, we are going to see a drop, but they have such a strong pipeline coming through. Hopefully, it won't be as steep as what is anticipated, but it is 100% priced into that stock. If this stock did not have those fears around it, it would probably be worth $150, $160. So it's definitely
Even
priced
more,
in. Yeah,
double the price. Yeah.
maybe not double the price because of the debt profile that we spoke about, but it would certainly be a little bit
Okay, that's what you mean.
higher.
Yeah.
Yeah.
Yeah. No, I was thinking then probably the balance sheet would have also been cleaner. That's what I was thinking. And then you can compare it to industry peers. So yeah, no, this, like you said, totally priced in.
Yeah. So as I said, and I always say this with ABBV, understand your risk. Great company, but make sure you understand what you are buying.
And then the next question is from Nick Scott, also a person that's really nicely engaged. So hi, Nick. Really nice to see your question here. And he's asking what we think about European dividend-focused ETFs like the Eurostoxx Dividend 30 or the MSCI Europe Quality Dividend ETF.
I mean, I'm not against ETFs, and I've said this for beginner investors. ETFs are probably a good way to go. I would not understand it enough to say if these are good for investors to go with. There may be better ETFs out there that give you better returns over the long term. Certainly, if your goal is to get a diversified portfolio across dividend companies in Europe, then 100% I would go with. In Ireland, I would have to go with an accumulating ETF and not distributing because of tax reasons. But I mean, I'd have no qualms about going with those if that is your goal, just to get a diversified portfolio of dividend companies.
So what I can just add to it, and then this more to you, Nick. Nick, please read their policies of what is in their portfolio. So I did a research. I have an article on my blog. You can just go to my blog, Nick. Just search for dividend ETF or something like that, and you will find it. You will find 5 stocks that are reviewed. What many of the European stocks have? They don't have growth at all. Those ones. And the titles of the ETFs are often misleading, and they're really poor composed ETFs. I haven't studied these two, I believe. Maybe the MSI one I looked into. I was really not under impressed with this. So some of these, they say like dividend growth even or something like that. It's so misleading because their dividends are going nowhere. They have companies in there that are more like high yielders in Europe, but highly fluctuating as well. So the only thing I can say, when you buy ETFs, don't look at the title of the ETFs. They're really often misleading, but look at what their policy is, and then you will figure out that it is not dividend growth or something like that. And it might not match with you as a dividend growth investor, because what you will get is you will get the same dividend for the next 10 years. There's no growth in it. So in the end, inflation will eat it up, let's say. So that's only, Nick, that you need to be aware of with these kinds of ETFs. Read their policy.
That's a great point. And I just looked at the companies in the Eurostoxx Select Dividend 31, and it's a lot of insurance, a lot of energy, a lot of utilities, mixed with telecommunications, and then you've got the likes of Ahold and other companies in there.
Mm-hmm.
So does that align with what you're looking for? If not, maybe they're not for you. But no, that's a great point from you. Yeah.
Okay, and then the next question is from Jens from Twitter, Honjokker Invest, and he's asking, he effectively would like to hear our thoughts about Carrier Global with ticker CARR.
Yeah, so I did a little bit of reading on these after we mentioned it last week, that we'd have a look at them. And to be honest, I, I'm not totally impressed by them. To be fair, they are a spin-off of a company. I think it was, what's the name of the company? United. Oh, I can't remember the name of the parent company, but the company was spun into, I think, 4 different parts. The CARR focuses on heating, ventilating, air conditioning, refrigeration, and fire and security. And the moment I seen that, my first question is, okay, what's the competitive advantage here? I don't see it. There are a dozen companies that can do that. What will drive growth in the future? I mean, I've seen articles say climate change. I question that on something like this. Yes, there is a demand for heating and ventilation and aircon, but I just don't see where their competitive advantage lies, and I don't think climate change is going to impact that enough for that to drive that. They are easily, in my view, disruptable. I mean, as a consumer or as a businessman, I don't care about the brand. I mean, that brand doesn't carry enough weight for me. I think United Technologies as a whole brand, when they're in aerospace and other different sectors, may have carried some weight, but I don't think CARR carries enough weight to get them through. I see in a recession, I mean, I think they would struggle really, really, really badly. So I was not overly impressed. I didn't even look into the financials after that, because my first thing is I just can't see what is unique about them enough to warrant me actually investing in them.
It's funny that you say it, because you know that I owned UTX, United Technologies, for a year or something like that. I bought a position. Then it was acquired by Raytheon, and then it's when it's also did the spin-off. So actually, I owned CARR Group for, I think, for 1 day, and I sold it straight away because of the same thing. When I saw HVAC, I thought, okay, gone, no mode. I don't need a former industrial kind of old type 90s industrial. I don't want it. And there's a reason why they spun it off. So, but this is, of course, not a recommendation for you. It is more like these are companies that typically have no modes, right? And it just doesn't fit in my portfolio. And that's the context, I think, why we give this feedback.
Yeah,
it might be a brilliant company 10 years from now, but nothing that interests me here.
Yeah, I mean, I could be sitting here eating my words in 10 years' time, but for me, one of the first things I've learned is to look at, is there a competitive advantage? I don't need to understand it completely, but I just need to know that there is one, and what will drive growth.
Yeah.
And I just don't see that. So once I saw that, I'm like, do you know what? I'm not going to waste my time looking into their financials any further.
Yeah, same here. So good. Thank you, everyone. It was really great to do portfolio review and to process these questions that we still owed you. We're coming to the end of the show. We're not doing a stock pick today. I think you heard like at least 6-7 tickers today and our opinions about that. So it should be enough from that point of view. So, hey, EMF, thank you again. It goes so quick, these conversations. I know we will still talk for 2 hours offline after this, probably just about everything and anything. But guy, we're at 63 or 64, 63rd episode already. I mean, I'm sure we'll do another 63. So thank you for being my buddy, my partner, and just having fun with you. Thanks.
Yeah, no, and thank you. And to our listeners, for any of the diehards that have stuck around this long, we are obviously on Twitter, but we also are on Facebook. So we have a Dividend Talk group on Facebook. If you haven't done so already, please go and like there. We're trying to build that community and grow it. European DGI is a little bit more active there than I am at the moment, but we are hoping to get a community there a little bit more active. So if you're listening and you stuck around this long, just hop over to Facebook and hit that like button. And hopefully we'll see you all here next week.